Hey everyone, Brian Lahr, One Life Financial Group. Today's video is focused on child tax credits while you're married and if you're divorced. So if it's your first time, welcome to the channel. We are in a heavy tax season and having a lot of conversation with clients and their accountants about strategies to minimize their tax bill for 2023 and also for 2024. Something that we're looking at and encouraging clients to talk to their accountants about is maximizing potential tax credits. So in today's video, we are exploring three things. The first is, what is the child tax credit and who's eligible for it? The second is steps you can take to maximize that potential credit if you're married with children. And a third way is a creative strategy that some divorced parents have worked together on to maximize the credit for the benefit of their situation and their children's. All right, so let's dive in. What is this child tax credit and who is eligible for it? So there are several criteria for this credit. Check out the link in the notes to go through all of them, or just talk to your accountant. One is the child needs to be under the age of 17 at the end of the year. Number two is provide no more than half of their own financial support during the year. Number three is have lived with you for more than half the year. Number four, be properly claimed as your dependent on your tax return. And if you're divorced and want to give that credit to a spouse who qualifies for it, if you don't qualify for it, you need to file Form 8332 to let the parent take that credit. If you're not eligible for it, be a U.S. citizen. So check the IRS website for the other credits. Now, if you do meet those criteria, you could be eligible for up to $2,000 per qualifying child. So that can really add up, especially if you're like me and have 7 children. So there could be a lot of money on the table if you can qualify for the credit. So basically for 2023, if you meet those requirements and your annual income is not more than $200,000, if you're filing an individual return, or $400,000 for a joint return, you could be eligible for that. If you're over that limit of taxable income, the credit's reduced by $50 for every $1,000. So basically, if you're $40,000 over the income limit, that would be $240,000, or $440,000, you would not be eligible for a credit. So we know what's on the table now. It's up to $2,000 per child. If they are 17 by the end of the tax year, it goes down to $500. All right, so that is number one. We talked about what the credit is. Now let's talk about number two. So steps you can take to maximize that potential credit. If you are close to the limit of $200,000 or $400,000, depending if you're filing single or jointly, something that you can do throughout the year is you can work to lower your taxable income. And we'll probably dive more into that in a separate video, but a couple of just high-level quick strategies might be increasing contributions to a 401k plan, a retirement plan, a deductible IRA, charitable giving strategies, or deferred compensation. Could all lower your potential income and help you qualify for that credit. Now, at this time of year, before the tax filing deadline, if you are eligible to make a tax-deductible IRA contribution, that could potentially lower your income and help you qualify. If you're a small business owner, making a profit sharing or a SEP IRA contribution could also lower your potential taxable income if you are close to that limit. So those are some ideas to qualify if your income is close to or over that limit. The third thing we're going to talk about is a creative way that divorced parents could explore to work together to maximize that credit. So what could they do? Let's say that there's a divorced couple. We'll just say it's Bob and Betty. I recently had a client in the office. I've changed the details of their situation. I've changed their names for this example. But here's the scenario. Let's assume that Bob's income is $240,000. He's a single filer, so he qualifies for basically $0 out of that $2,000 credit. And so Bob doesn't like this idea. They have twins who are 3 years old in this scenario, so they have 14 potential years of tax credits. Now, Bob and Betty in their divorce decree, they agreed to each claim one of the children. And so basically for Bob, if his income stays there, he's losing out on a $2,000 credit if the tax code stays the same, that could be over 14 years. That could be $28,000 that's left on the table in credits. So Bob has an idea. He talks to his accountant and he goes to Betty and says, hey, Betty, I'd love to help get more money in the kids' college fund for their future. I would like to give you both children, the twins, and you can claim them this year. And I would just like you to put that money into their college fund to help them secure the future. And Betty thought that was a great idea. And her accountant said, you'll actually get some state tax credits for making that contribution. So it helped the kids, it helped Betty. And if that scenario played out for 14 years straight, because Betty qualified with her income and Bob did not, that could be an extra $28,000 growing tax-free in college funds. And here's the kicker in that scenario. There's a new law that was passed that basically says that unused 529 funds could be eligible to move to a Roth IRA. So if the child doesn't go to college or they get scholarships and they qualify, there's some requirements. They can move unused funds into their own Roth IRA. So we just talked today about the child tax credit, what it is, what married and divorced parents can do to potentially maximize their potential credits. A disclaimer for you is this: I'm not an accountant. I don't give tax advice. We talk a lot about tax minimization strategies. So please talk to your accountant before acting on any new strategy. If you are not sure how to minimize your tax bill this year, if you're looking to create a plan to secure your future, and you need help getting started, we would love to connect with you. You can request a free consult up top. If you want to get notified on our next video, hit that subscribe button, and I look forward to seeing you soon. Happy tax season.